Welcome back. You're with us at the Big C, and Juerg Kiener continues with us. Juerg, you spoke about copper as well, on how we've seen money rotating from one to another and how it continues to be a bull market. But when it comes to copper, and we've seen an all-time high into this one, aluminum is trading at a multi-year high. There's a lot of support that we've seen in zinc come in 2025 also. How are you looking at the fundamentals for this? And as you said, is there an expectation that the base metal prices will continue to surge from here?
I think, if you look at commodities and you use the CRB index as an example, and you compare it with, let's say, the Dow, and you start realizing we've basically gone 90% down versus the Dow over the last, 14 years. So we have a long way to catch up to actually square that book. And why do I think we're going to do that? We have seen massive underinvestment till about a year ago because people couldn't make any money. So you start high grading, your production gets a bit tired. We've seen a lot of mines which have been in difficulties lately, and it takes time to bring them back on stream. So the market will basically penalize that, and it will re-rate faster until this new production is coming back on stream.
And would you expect all the metals to do well, or do you think the greener metals, especially copper, would perhaps outperform the others, as it has done this year?
I think silver is probably the one which will continue to really run really hard because AI and the green investment is asking for roughly about 350 million ounces of silver supply to get that going. And 350 million in today's production is about 40% more production over the next 3 years, which is required. I can't see that work. So it's going to need higher prices to accelerate new production. And new production is a question of licensing, investments, getting things done. It takes years. So we're going to see that certainly the silver space, we see the palladium, platinum space, we see it in copper for sure. We see it probably in all other metals too, because on the end, they're all correlated. And once the index starts turning, you're going to get investment funds coming in, playing the market. So we're going to go at least to the mean level for all commodities. And that's a long way to go for all of them. If you think oil, we are at $60, maybe we fall down to 50 before we go to 80. But if you look, oil is cheap, very cheap, considering we had massive inflation over the last 10 years, we're trading at a discount. So if you want to have a little bit of purchasing power parity for commodities, they have a long, long, long way to go.
Juerg, while you clearly are very, very bullish on silver, and it perhaps would continue to outperform going forward as well, how are you looking at the dollar index from here? Because some support perhaps many of these commodities did get from dollar index and those interest rate cuts. Do you see a repeat of that in 2026?
I'm looking at a failed currency, basically. And the failed currency has been seen on how the BRICS are rearranging their business, where they don't use dollars. Therefore, you're going to have fewer dollar reserves. You're rolling over fewer dollar reserves at the time when America has an investment cycle to onshore. So they need to issue more debt on themselves, which they have to buy themselves. And in general, that means a lower currency or less purchasing power. And it's going to be probably a mix of both.
How would you also look at the interest rate trajectory going forward, Juerg?
In a way, when you start having to rebalance the global structure in finance to that level, the only way you can do that is by actually supporting it so you don't have a recession, because restructuring means always headwinds. So we're looking at governments to print much more money. So debasing more money, and that's creating actually an inflationary support wave in that environment. And that means you as an investor who then looks to park money, is getting really difficult which way you want to go. And then you see the United States, which recreates its own currency. And the question is how we do back the short end and how do we back the long end of the treasury at a time when maybe foreign demand out of Asia will slow down. And that creates, in general, higher interest rates, particularly on the longer end. And that creates havoc in today's environment. So the only way you could do that is monetize even more. That means more debasement and higher prices.
Juerg, we've seen on what's happened with Japan, what with the currency and the yields as well, bond yields as well. But the way we've seen gains come in for euro and perhaps a Swiss franc and even Chinese yuan within the Asian markets did well. And look at the Indian rupee trading at a record lows.
Yeah.
How have you seen various currencies on why and the way they've done it?
I mean, if you think the US has been lowering interest rates and they're going probably another round lower if it comes to Mr. Trump, to stimulate his economy, at least in the short end. And that means, when you have interest rates now in Japan being higher than actually in the US, why would you take your money in Japan and go back to the US? So, we have a weak currency, but now we start getting paid slowly but surely more than in the US. So whilst we might still have a bit of a currency crisis, interest rates become attractive for domestic people without having currency risk. So don't be surprised on the end if maybe the yen will have a certain turn. The credit market is already showing in the US that we have problems. So if these problems escalate further, some of that money from overseas might actually disappear on the overnight scene and basically stay home instead of going out in foreign markets and peddle around.
All right. Juerg, I have to talk to you about the crude oil prices also, where we're looking at prices continue to decline. Clearly, overnight has been a bit of a gain with the Venezuela and Ukraine attacks on Russian oil facilities yet again. But we do understand that we are working with a surplus here, not just this year, but the next as well. And that is keeping prices really in check. What are you watching out for in case of crude prices?
Okay, if you look at actually oil, you have so many different prices around the world. We have different quality, we have different supply structure which are dislocating. So when everybody just looks basically at NYMEX or one of the indexes, it's really representative to what people pay on the end. And the answer is probably not. You can probably buy Russian oil at a discount, a significant discount. That's probably the floor. But at one stage, the market will start looking at a higher cost because of all this logistics problem we have. Tankers are a problem. We see tanker freights going up significantly. So I would look at maybe the financial market trying to pressurize energy down for another round. But I think that will be a hockey stick structure with high inflation, higher prices going into 26, 27.
And what would a range that you would put out, Juerg? Because in this case as well, again, just quoting various other banks as well, there has been a range that talks about 52 on the lower side and then 75 on the higher side.
Yeah, the higher side could be even higher than that. But yeah, 50, 52, somewhere there is probably a good support, even if the cost structure of the lower producers are much lower. I think on the end, it's capital investments into the commodity space, which might drive the prices. And if you look at most Wall Street banks like Morgan Stanley, Goldman Sachs, JP Morgan, all of them are coming back and saying you should actually rethink your asset allocation. Today, you have close to nothing in the precious metal market. You have nothing in the commodity market. You're long basically NASDAQ AI, which is going through a large investment capital cycle, whilst your energy companies are sitting on double-digit free cash flow. So I would expect that money will start flowing into the space which has free cash flow. And that's probably going to drive prices higher.
Juerg, how are you looking at the natural gas also? Because that seems to be like a lone gainer there. Coal just about turned positive. We've seen heating oil, gasoline prices kind of decline in this year. Of course, natural gas is very, very volatile from where we started to where we stand, an expectation that we could perhaps decline yet again by the time it's March as the winter demand gets done with. But overall energy as a pack, and add in the fossil fuels like coal into it as well, how would you look at the mix going forward?
Look, I think it's driven by policies which are changing everywhere. And who knows if the war finished in Ukraine, we might get gas coming back into Germany. So there might be a great support. At the moment, I can't see that. I think we're still looking at escalating wars. Mr. Trump is against the war and Europeans are pro-war. So I think we're going to find sooner or later a settlement because this war is, from my point of view, already more or less decided. The losses are just too big, and I think it's about time to get into a peace settlement. And that might mean actually more flow from Russian gas into Western Europe if we'll find a settlement. And therefore, it's getting really difficult to predict natural gas prices.
Yeah, the final question, and I want to wind it down with agriculture. While we understand that the inflation has been in control for the last couple of years, especially the current year, but as money does rotate, as there is a pattern there as well, do you see agriculture at any point in time gaining or funds allocation getting in that space as well?
I think we've seen allocation already to cocoa and coffee, the smaller areas, particular things which have been produced in emerging markets, which have been well supported. And I think we have harvest problems. We have as well different ways of exporting them nowadays, so they look quite well supported. The grains, I don't really have a very deep opinion. I think grain depends quite often on the climate, but as well on energy. It's quite costly and energy hungry to produce that. And the third entry on the grain is the Ukraine, which probably will be having a shortfall down the road, and probably is export market if they can't get through Russian territory and their port. So it's going to be landlocked. So that might drive prices in the short term, but I'm not having a very big opinion about where price is going to go, but I would expect quite a bit of volatility.
All right, and that's exactly what we are prepared for 2026 after what we have seen in this current year as well. Juerg Kiener, always a pleasure talking to you. Thank you so much for taking us through the whole segment asset class, that is commodities, and expectations on what 2026 could shape up as. But with that, that's all the time that we have on the show. Thank you so much for watching.